What is DeFi? So, what is the financial future? Is decentralized finance superior to the present financial system? What issues does it address? And does it have the potential to enhance or fully replace conventional finance? Let's find out. DeFi, which stands for decentralized finance, is a new financial system that is built on secure distributed ledgers, similar to those used by cryptocurrencies. The system eliminates banks' and institutions' control over money, financial goods, and financial services. Let's start by going back to go forward. The background. The financial system we know today is the result of decades of technical progress. The development of accounting computers and punch cards in the 1920s was one of the first initiatives to make finance more efficient. This was followed by the introduction of mainframe computers, which substantially accelerated the financial system in the 1950s. The introduction of ATMs and credit cards, which became ubiquitous in the 1970s, was the next revolution. In addition, another crucial component of the financial system, the stock market, began undergoing significant transformations in the 1970s. Manual order entry and noisy trading pits were gradually replaced by computers and algorithms. From the 1990s, due to the increasing acceptance of the internet, the computerization of finance was accelerated. Accessing bank accounts, making wire transfers, and purchasing stocks were now all feasible from the comfort of our own homes. Then there's the financial technology revolution. PayPal, Robinhood, TransferWise, Revolut, and other fintech firms recognized the take-first strategy used by non-financial IT businesses and provided its consumers with smooth access to financial services, providing an entirely different experience than the laggy banks' user interfaces. Despite a century of improvement, the financial system is far from ideal. The settlement of stock, bonds, and other financial instruments still takes days and necessitates a vast quantity of human capital engaged in the process of important choices affecting millions of people. To comprehend decentralized finance and how it operates, it is necessary to first grasp how centralized finance differs from DeFi. Centralized finance. In centralized finance, your money is kept by banks, which are organizations whose main objective is to earn money, and third parties that enable money flow between parties abound in the financial system. With each demanding a charge for their services, they also help to maintain a smooth flow of the financial system. Assume you use your credit card to buy a gallon of milk. The charge is routed from the merchant to an acquiring bank, which then passes the card information to the credit card network. The network clears the charge and asks your bank for payment. Your bank accepts the charge and forwards it to the network, which then forwards it to the merchant through the acquiring bank. Decentralized finance. Decentralized finance, on the other hand, removes the third party and the bank by enabling individuals, merchants, and enterprises to execute financial transactions between them using developing technologies. This is performed using peer-to-peer financial networks that use security protocols, connection, software, and hardware improvements, and so on. You can lend, trade, and borrow using software that records and validates financial transactions in distributed financial databases from wherever you have an internet connection. How does DeFi work? DeFi makes extensive use of cryptography, blockchain, and smart contracts. DeFi's basic building components are smart contracts. A blockchain is a distributed and secure database, often known as a ledger. To process transactions and manage the blockchain, applications known as dApps are utilized. Transactions are stored in blocks on the blockchain and subsequently validated by other users. If these verifiers agree on a transaction, the block is closed and encrypted, and the new block containing information about the preceding block is generated, while cryptography restricts access to a message's contents to the sender and intended receiver. Data is encrypted using a secret key in this case, and both the encoded message and the secret key are then delivered to the receiver for decryption. And smart contracts are essentially programs that execute when certain criteria are satisfied and are recorded on a blockchain. They are also used to automate the implementation of an agreement so that all parties are instantly confident of the result, without the participation of an intermediary or the waste of time. Developers use these three components of DeFi to create DeFi products. One of the basic tenets of DeFi is peer-to-peer or P2P financial transactions. The ability for two users to conduct digital payments directly to one another was one of Bitcoin's fundamental advances. This is simple to achieve in the actual world using paper or metal money. However, prior to Bitcoin, the only method to do so electronically was through a bank or payment business such as PayPal. Going through such third parties creates a digital trace that may be tracked, and those firms may be censored by the government for political or other reasons. Bitcoin was designed to circumvent this by serving as a digital form of currency for peer-to-peer payments. So, what are the components of DeFi? DeFi is made up of four distinct layers: settlement, protocol, application, and aggregate. All DeFi transactions are supported by a settlement layer, which enables you to execute public financial transactions using an open-source blockchain and its associated cryptocurrencies, such as Bitcoin or Ethereum. The scale of these networks may vary from the vast Bitcoin blockchain network to tiny homegrown blockchains like Dogecoin, which may expand quickly depending on user participation in the underlying computer processes that generate the value of the digital currencies they support. DeFi systems are often based on software layer 1 or implementation protocols. These provide a common underlying architecture and set of rules upon which the blockchain network is based, and on which both users and developers may perform digital token transactions. As a result, the protocol layer enables digital currencies to be liquid and have monetary value. The application layer consists of any public-facing programming apps that allow you to buy, sell, or exchange digital tokens, often cryptocurrencies, created and managed by blockchain networks. The aggregation layer is often composed of services that gather or aggregate consumer-facing applications. As a result, users may buy, sell, and exchange a variety of digital tokens and currencies across several blockchain networks. Most users will interact with this layer of the DeFi system on a regular basis without ever having to interact with the underlying blockchain networks and software protocols that support the whole DeFi system. Can DeFi really replace traditional financial systems? To give an answer to that, first, DeFi should be able to tackle the concerns that conventional finance faces. So, let's have some of the problems DeFi solves. DeFi makes use of cryptocurrencies, which are available to everyone with an internet connection. Users may trade and transfer assets at any moment without having to wait for bank transfers or pay bank fees. Due to the open nature of DeFi, interest rates are changed multiple times each minute, and the blockchain is updated as soon as the transaction is done. And every single transaction is open to the public. You may also invest in stocks and conduct peer-to-peer transactions. If the seller approves and you wish to deal with DeFi, you may buy a property with crypto by turning crypto into cash using developing technologies like BitPay, which can be used to make payments for genuine items that are normally paid for in dollars. Another potential advantage of DeFi was highlighted by the economic effect of COVID-19 and how banks reacted. In response to the pandemic recession, certain central banks decrease interest rates in order to keep consumer spending going and secure the community. However, this diminishes the effective net worth savings. Under a DeFi, this central bank's capacity to manage the value of its currency would be significantly more difficult, if not impossible. In other words, DeFi allows clients to safeguard the value of their assets against central bank manipulation. DeFi, on the other hand, has various downsides, in addition to eliminating difficulties. Users of DeFi, for example, are unable to safeguard the value of their assets against market swings. Furthermore, since DApps are a relatively new technology, vulnerabilities exist, and there are a number of tax implications involved with purchasing, trading, and investing with DeFi coins. Security has also been called into doubt, notably when hackers stole $600 million in Bitcoin from the Poly network in August 2021. Finally, rules and regulatory frameworks are still being developed. It's uncertain how authorities will respond, in particular to stablecoins coexisting alongside central bank digital currencies. Furthermore, a provision in the $1 trillion federal infrastructure plan passed by the Senate in August 2021 requires Bitcoin brokers to report transactions of $10,000 or more to the IRS. The rule is designed to increase tax collection in order to help pay for infrastructure spending, but cryptocurrency dealers feel the provision is too broad and would stifle innovation. Decentralized finance is still in its early phases of development. To begin with, it is unregulated, which means that the ecosystem is still rife with infrastructure errors, hacks, and frauds. Current legislation is founded on the concept of distinct financial jurisdictions, each with its own set of laws and norms. The potential of DeFi to conduct borderless transactions raises critical issues for this sort of regulation. Who, for example, is in charge of investigating a financial crime that happens across borders? Protocols and DeFi apps? Who would enforce the rules, and how would they be enforced? Many issues must be addressed, and advances must be made before DeFi can be utilized instead of conventional finance. However, financial institutions will not give up one of their primary sources of revenue. And if DeFi succeeds, banks and businesses will find means to get into the system. If not to control how you access your money, then to profit from it. And if you want to learn more crypto topics, then check out our playlist on screen now.